Hello, students! Welcome back to the ACE Archive, and welcome to today's Explainer. I am so thrilled to have you here because we are tackling two absolutely crucial topics in financial management for your CBSE Class 12 exams. We're talking about the factors affecting dividend decisions and financial planning. We're going to break these concepts down in a super simple, easy way. So grab your notebooks, get comfortable, and let's make sure you are fully prepared to ace these topics.
Okay, let's take a quick look at our roadmap for today. First, we'll decode dividend decisions. Then we'll look at market and shareholder factors, followed by rules and constraints. After that, we're diving into the types of financial planning, and finally, we'll wrap up with a solid exam revision. To make those 11 dividend factors highly memorizable, we're going to chunk them into logical groups. Let's get into it.
Section 1. Decoding dividend decisions, earnings, and cash. This is our very first logical bucket of factors, focusing entirely on the core money the company actually makes and holds.
So at the heart of every single dividend decision is this fundamental tug-of-war. Whenever a company earns a profit, management has a massive core choice to make. Do they keep that profit inside the business for future growth, what we call retained earnings, or do they distribute a portion of it out to the owners, the shareholders, as dividends? Think of it like a giant scale. Every single factor we're about to study influences which way that scale tips.
Now, you literally can't pay out what you don't have, right? And this brings us to factors 1 and 2, the amount of earnings and the stability of those earnings. It's actually quite simple. The sheer amount of profit naturally allows for a higher dividend. But beyond just having a lot of cash one time, the stability of those earnings matters just as much. If a company has stable, predictable earnings year after year, that consistency really promotes a higher dividend payout. Why? Because the company feels totally confident that they're going to make money again next year.
Next up is factor 3, which is the stability of the dividend itself. Maintaining a stable dividend, meaning you don't drastically cut it one year and suddenly raise it the next, is a very deliberate policy choice. So why do companies do this? Well, it massively improves the confidence of the shareholders, and it builds a much higher reputation for the company in the broader market. It basically signals to everyone that the business is reliable, steady, and rock solid.
And that brings us to factor 4, the cash flow position. Listen, the payment of a dividend involves an actual physical outflow of cash from the company's bank accounts. You could have absolutely huge profits on paper, but if that money is all tied up in inventory or unpaid bills, well, you can't exactly hand that out to investors. Therefore, enough physical, liquid cash must actually be available to declare those dividends.
All right, let's quickly pause and lock this first chunk into your exam memory. Our 4 internal money factors are the amount of earnings, the stability of those earnings, the policy of maintaining the stability of the dividend, and finally, the actual cash flow position. See? That's 4 out of our 11 factors completely knocked out already. Great job.
Section 2. Market and shareholder factors. We're now shifting our focus outward, looking at those external market forces and what the shareholders themselves actually desire.
Let's dive into factor 5, shareholders' preference. You got to remember who actually owns the company, right? The shareholders. And normally they want to get a regular income from their investments so they can, pay their own bills. Because of this strong preference, a company is generally going to try to ensure that at least a minimum dividend is distributed every single year just to keep those investors happy.
But here is the counterbalance, and this is factor 6, growth opportunities. If a company has big internal growth and expansion projects lined up, like, say, building a brand new factory or launching a massive new product line, well, they need money to fund all that. In this case, fewer dividends might be given to the investors, so the company can hold on to those profits to finance its own expansion. It's a real trade-off.
And let's see how this builds right into factor 7, stock market reaction. You see, investors generally evaluate companies based on their dividend declaration status. It's just human nature. Because of this, a higher rate of dividend usually creates a super positive impact in the stock market, which drives the share price up. It acts as a massive, glowing signal of financial health to the rest of the world.
Factor 8 is access to the capital market. Reputed, well-established companies generally have super easy access to capital markets. Basically, if they need money to grow, they can just issue new shares or bonds without much fuss. Because they can easily raise outside funds whenever they want, they depend a whole lot less on keeping their retained earnings. Consequently, these big, reputed companies are in a position where they can comfortably declare a much higher rate of dividend. All right, time to lock in chunk number 2. These external market factors are satisfying the shareholders' preference for income,
balancing that against the company's growth opportunities, managing that critical stock market reaction, and leveraging the company's access to the capital market. You are doing amazing, guys. We only have one group left.
Section 3, Rules and Constraints. We are now moving to our third and final chunk of dividend factors. These are the legal and contractual roadblocks companies face because, hey, you can't just pay out whatever you want. There are rules to follow.
Factor 9 is taxation policy. Tax rules severely influence dividend decisions. According to our syllabus, if the tax on dividends is higher, it's just better for the company to pay less by way of dividends. Interestingly, a dividend distribution tax is actually levied directly on the companies themselves, which makes those dividends tax-free in the hands of the shareholders. But from the company's perspective, a high tax means a lower payout.
Factor 10 brings us to legal constraints. Look, a company cannot just empty its bank accounts to pay its shareholders. While declaring dividends, companies have to strictly follow the legal restrictions laid down by the Companies Act. The law steps in here to ensure that a company actually remains solvent and to protect the people it owes money to, its creditors. And finally, Factor 11 is contractual constraints. Often, a company is going to go to a bank for a major loan. While granting these loans, the lender might impose certain strict conditions on the payment of dividends in the future. I mean, it makes sense, right? The bank wants to make absolutely sure the company uses its cash to repay the loan first before handing it out as a bonus to the shareholders.
And boom, there we have the final chunk. Taxation policy, legal constraints from the Companies Act, and contractual constraints from the lenders. Huge congratulations, you've just successfully navigated all 11 factors affecting the dividend decision. By remembering them in these 3 neat little chunks, you're going to have absolutely no problem recalling them during your exam.
Section 4, Types of Financial Planning. Now, we've talked a lot about what to do with today's profits, but what about the future? Financial planning involves estimating how much finance you need, determining the pattern of that financing, like choosing between equity shares or taking out loans, and then ensuring the proper utilization of those funds so absolutely nothing is wasted. Once you have that foundation, we categorize financial planning by time.
So as we look at the time horizons, financial planning is fundamentally classified by the period it covers. On one side, we've got long-term financial planning. This usually spans a period of 3 to 5 years. This is the big picture stuff, guys. We're talking about planning for major expansion projects, setting up totally new plants, and making those massive investments that are going to shape the company's long-term future.
On the completely flip side, we have short-term financial planning. Now, this is usually for a period of 1 year or less, and it often takes the form of a really detailed budget. Short-term planning is all about survival and efficiency today. It's managing those daily operations, making sure you can pay salaries next month, and ensuring you have enough working capital just to keep the lights on for the current year.
Section 5, Exam Revision. Let's do a final run-through right before the bell rings.
All right, here is your final exam checklist. Dividend decisions are a massive balancing act driven by 11 factors, which we chunked into earnings, market, and rules. Got it? For financial planning, just remember the core steps: estimating, sourcing, and utilizing your funds. And for the time horizons, long-term is that 3 to 5 year strategic vision, while short-term is your 1 year or less operational budget. Keep these distinctions crystal clear in your mind, and you are going to do absolutely fantastic.
And that wraps up our explainer for today. If this simple, structured lesson helped you feel more prepared, please go ahead and hit like, share, and subscribe to the ACE Archive so we can keep bringing you these clear explanations for all your syllabus needs. Best of luck on your exams. And before you go, I want to leave you with a final thought to ponder. If you were the CEO of a highly profitable company right now, would you rather reward your investors with massive dividends today or keep that cash to build the empire of tomorrow? Think about it. See you next time.